Money. It's a word that resonates with everyone, no matter where you are in the world. It's something we use every day, often without giving it much thought. But have you ever stopped to think about what it really is? What does money represent in our lives? Money is how we buy things, from the smallest necessities to the grandest luxuries. It's how we get what we need and want, enabling us to fulfill our desires and meet our basic needs. Without money, our world would be a very different place. The convenience and efficiency it brings to our daily lives cannot be overstated. Imagine a world without money. It would be chaotic and confusing. You couldn't just walk into a store and buy a snack. You'd have to find something of equal value to trade. You would have to trade something you have for something you need. This system is known as bartering. Bartering was the primary method of trade before money existed. It was a cumbersome and inefficient process. The invention of money revolutionized trade and commerce. It has shaped the course of human history in profound ways. Money has built empires and fueled revolutions. It has been a powerful force for both good and bad. It has also been a source of great inequality and conflict. The distribution of wealth has always been a contentious issue. In this essay, we'll journey through the fascinating history of money. We'll explore its origins and its impact on society. From ancient barter systems to the rise of Bitcoin, we'll delve into the evolution of money. We'll explore how money has evolved and what the future might hold. The story of money is far from over, and its next chapter promises to be just as intriguing. In the beginning, there was no money. People had to rely on their skills and resources to get what they needed. If you wanted something, you had to find someone who had it and was willing to trade. This meant that communities were built on trust and mutual benefit. This system, called bartering, was how people got what they needed for thousands of years. It was a direct exchange of goods and services. Imagine a farmer who has extra wheat but needs a new pair of shoes. He would have to find someone who not only makes shoes, but also needs wheat. He has to find a cobbler who needs wheat and is willing to trade shoes for it. This could involve a lot of searching and negotiation. This could be difficult and time-consuming. Bartering has its limitations. The biggest challenge was finding someone who had what you needed and needed what you had. What if the cobbler doesn't need wheat? The farmer would have to find something else the cobbler wanted. What if he wants something else, like a goat? The farmer would then need to find a goat to trade for the shoes. This is called the double coincidence of wants problem. It made trading cumbersome and inefficient. The need for a more efficient system led to the development of commodity money. Items like shells, beads, and eventually metals became standardized forms of currency. These items had intrinsic value and were widely accepted, making trade easier and more efficient. This was the beginning of the monetary systems we use today. Over time, money evolved into the complex financial systems we have now, facilitating trade on a global scale and allowing economies to grow and prosper. People started using certain goods as a medium of exchange. These goods, like salt, cattle, or shells, were valuable to everyone. This was the beginning of commodity money. Over time, metal became the preferred commodity money. It was durable, divisible, and portable. The first coins were minted in Lydia, modern-day Turkey, around 600 BC. Paper money came much later. It was first used in China during the Tang Dynasty in the 7th century. People deposited coins with merchants and received paper receipts as proof of ownership. These receipts eventually evolved into paper money. Today, most of our money doesn't exist as physical cash. It exists as electronic records in banks. But how is this money created? Central banks, like the Federal Reserve in the United States, are responsible for monetary policy. They control the money supply through various tools, including setting interest rates. Commercial banks play a crucial role in money creation through a process called fractional reserve banking. When you deposit money in a bank, it keeps a fraction as reserves and lends out the rest. This creates new money in the economy. This system, while efficient, can be vulnerable to crises. If too many people try to withdraw their money at once, it can lead to a bank run. Section 5. Money in the digital age. We are witnessing, a digital revolution in money. The rise of the internet and mobile technology has paved the way for new forms of money and payment systems. Digital money, in the form of online banking, credit cards, and mobile payments, has become increasingly popular. This has led to faster and more efficient transactions. Central banks are also exploring central bank digital currencies, or CBDCs. These are digital versions of a country's fiat currency, issued and backed by the central bank. CBDCs have the potential to revolutionize the financial system. They could increase financial inclusion, reduce costs, and combat money laundering. Section 6. Different kinds of money. Throughout history, we've used different types of money. From the earliest days of bartering goods and services, humans have always found ways to facilitate trade. Ancient civilizations used items like shells, beads, and even livestock as forms of currency. As societies evolved, so did their methods of exchange. Today, the most common types are commodity money, fiat money, and cryptocurrencies. Each of these forms of money has its own unique characteristics and uses in our modern economy. Commodity money derives its value from the underlying commodity it represents. This type of money has intrinsic value because it is made of materials that have their own worth. Examples include gold coins, silver bars, or even cigarettes used as currency in prisons. These items are valuable in and of themselves, which is why they can be used as money. Fiat money is government-issued currency that is not backed by a physical commodity. Unlike commodity money, fiat money has no intrinsic value. Its worth is based entirely on trust and government decree. Its value is derived from the government's declaration that it is legal tender. This means that it must be accepted as a form of payment within the country. Examples include the US dollar, the euro, and the Japanese yen. These currencies are widely used and accepted around the world, making international trade and travel more convenient. Cryptocurrencies are digital or virtual currencies that use cryptography for security. They represent a new frontier in the world of finance, offering unique advantages and challenges. They are decentralized, meaning they are not controlled by any government or financial institution. This decentralization is achieved through blockchain technology, which ensures transparency and security. Bitcoin is the most well-known example. It was the first cryptocurrency to be created and remains the most valuable and widely recognized. Other popular cryptocurrencies include Ethereum, Ripple, and Litecoin, each with its own unique features and uses. Section 7. What money does for us. Money serves three primary functions in society: a medium of exchange, a store of value, and a unit of account. As a medium of exchange, money facilitates transactions. It eliminates the need for bartering, making it easier to buy and sell goods and services. As a store of value, money allows us to save purchasing power for the future. We can hold money and use it later when we need to buy something. As a unit of account, money provides a common measure of value. It allows us to compare the prices of different goods and services. Section 8. Problems with money. While money is essential for a functioning economy, it also presents challenges. Inflation, inequality, and the digital transformation of money are some of the most pressing issues. Inflation, a general increase in prices, erodes the purchasing power of money. High inflation can lead to economic instability. The unequal distribution of wealth and income is another significant challenge. A small percentage of the population holds a disproportionate amount of wealth, while many struggle to make ends meet. The digital transformation of money brings both opportunities and risks. While it offers convenience and efficiency, it also raises concerns about cybersecurity, privacy, and the potential for financial exclusion. Section 9. The future of money. The future of money is uncertain, but one thing is clear: it will continue to evolve. The rise of digital currencies, the potential for CBDCs, and the increasing use of artificial intelligence and blockchain technology will likely shape the monetary landscape of the future. Will cryptocurrencies become mainstream? Will governments issue their own digital currencies? Will cash become obsolete? These are just a few of the questions that remain to be answered. One thing is certain: the evolution of money is a fascinating journey that reflects our changing world. As we continue to innovate and adapt, the way we use and think about money will undoubtedly continue to transform.